So what makes more sense? Should you invest in the stock market, let's call it the S&P 500, or should you invest in a home? Let's jump into it and talk about it. And obviously it depends on the period of time. There's been periods where home prices have vastly outperformed the stock market, and there's also been periods of time where the stock market has vastly outperformed the real estate market. So it depends on timing, but let's look at things from where we are today. And the first question is, are we at a high in either one of those asset classes? And would that prohibit you, or would that lean you towards one or the other? And the reality is, we're at all-time highs for both of those asset classes, right? Real estate, we've seen how real estate prices have increased over the past decade and really accelerated since the pandemic. And same thing for the stock market. We're at all-time highs with the stock market. So let's put that into a category in both columns where the S&P 500 and real estate are equals. Now the question is, what's going to happen going forward, given that we're at all-time highs? Is that bad? And that's hard to say. If you have the answer to that question, you can make a ton of money. And anybody that tells you that they have the answer to that question is lying, because none of us know. What I can say is, anytime you have an asset that goes from lower left to upper right, in general the prices are going up. You know what, almost by definition, a majority of the time, you're going to be at all-time highs if you look over a period of time. So the mere fact that we're at all-time highs is not worrisome to me. I look at the fundamentals and say, can this asset class continue to go up, right? And we come back to supply and demand when it comes to homes and interest rates. And for the stock market, it comes to the fundamentals. What's the earnings power of these companies? And can the earnings power continue to go up at a pace that justifies the current ratios that people are paying, the price to earnings ratio that people are paying now? So that's the first one. But let's talk about some differences. You know, one of the nice things, but this does cut both ways. One of the nice things with homes is most of us don't pay cash. We don't put all the money down day one. Most of us are financing about 80% of the cost of the house. And so we can buy a $500,000 house, and we can get access to a $500,000 asset for just $100,000 down. That's that 20% down payment. And then the interest on that debt, although quite a bit higher than it was just a couple years ago, is about as low of an interest rate as most people are going to qualify for, right? For most of us, even though interest rates are high, our mortgage rates are some of the lowest debt that we can access. For most of us, it has to do with car loan. You might be able to get a car loan less expensively, but if you look at our other sources of debt, you know, most of that's what's called unsecured debt, and that's going to be much more expensive. So it's a mortgage is relatively low cost debt, and you can leverage that. You have access to that, and quite a bit of leverage. For every dollar you put down, most of us can borrow about $4 on that. But leverage cuts both ways. If the price of the house increases at a rate faster than interest rates, then you're making money on the bank's money. But if the rate of appreciation increases at a rate lower than the house price increases, then you're not gaining ground. Your debt is costing you more than what the asset is growing at. Now let's compare that to investing in the stock market, investing in the S&P 500. For most of us, we're not going to borrow money to invest in the S&P 500. Some people do. There are ways to do that. That's beyond the scope of this. And while none of this is financial advice, in general, for mere mortals, I do not suggest using debt to invest in the stock market, and or using leverage tools like puts and calls and options. And here's why. The S&P 500, the stock market, if you put $1,000 in, if you invest $10,000, if you invest $100,000, whatever the number is, the most you can lose is the money that you put in. And when the tide turns against you, that leverage can be really painful. I mean, eventually, if you have leverage and you're leveraging investments, unless you're very fortunate and very skilled, there is going to be a period of time eventually where that leverage cuts against you. And if you can't meet what's called your margin calls, if you can't satisfy the lender, they can then make you a forced seller in a down market. Let's say you do leverage on the stock market. And let's say you put in $100,000 and you have $100,000 in leverage. Again, I don't suggest this, but maybe if the stock market drops 20%, 30%, the bank is going to say, the person that lended you that money is going to say at some point, your collateral, the value of your stocks, is insufficient, and we need to start selling some positions in order to build up that collateral account. And that can happen at a market low, and then you are literally forced to sell at what may or may not be market lows. The market could still go down, but you're forced to sell at a time that you may not otherwise want to sell. Okay, these are kind of esoteric examples. Let's get more into the heart of the matter. And one of the big differences between a home and buying a home and using leverage and investing in the stock market is you can live in that asset and you can raise your family. So, for instance, in my case, I bought a home, and when my wife and I bought that home, my kids were younger, and I told my wife at the time, I don't know, but I think we're probably buying at the market high. And unfortunately, we did. We bought in July of 2006, which in my neighborhood was the high before the great financial crisis, when the value of my home probably dropped 20-25%. But I wasn't looking at it as a short-term investment. I was looking at it, yes, as an investment, but also as a place that I wanted to raise my family. And God willing, I did not want to be a seller for the next 20 years. I wanted to raise my kids. I wanted them to go to the local schools. I wanted them to be friends with the neighbors. I wanted them out riding their bikes in the summertime and skiing in the wintertime. So it's one of the few investments that you can actually really enjoy, right? A car's really not an investment unless you're really smart at buying cars and you know how to buy collectibles. For most of us, a car is a depreciating asset. A home is an asset that you can enjoy during the period that you own it. And over a long enough investment cycle, what history has kind of shown us, and people are surprised by this, but real estate generally goes up by the rate of inflation, which is different than the stock market. The stock market, historically, depending on the period of time that you look at, has beaten inflation and beaten inflation handsomely, to the tune of 3 to 7%, again, depending on the period of time you look at. The stock market has beaten inflation over long periods of time. Certainly you can find decades where that hasn't been the case. You can find decades where the stock market's been down, the S&P 500's been down. But in general, what we've seen in real estate in the last decade, the last 15 years, even the last 20 years, is an anomaly where the rate of house price increases have been higher than the rate of inflation. In fact, when I graduated college, for the median home in the United States, the median family, if they put away 100% of their salary, which obviously is not practical, but just for comparison, it would take the median family 4 times their take-home pay, 4 times their gross pay, to pay off the median house. And that number has now gone up to 6. It would take, the median house would take the median family 6 times their gross pay to pay off that house. Is that going to continue? I don't know. But at some point, we have to believe that there's a cap on that. Now, with the stock market, as long as companies continue to grow their profits, continue to grow their earnings, then in theory, over time, that price increase can be sustained as long as the companies continue to grow. Another thing about the stock market, and admittedly I'm biased here, I'm trying to be as unbiased in this video as possible, but I am a financial advisor, and most of my clients have built their net worth in the stock market. Not all of them, probably 10 to 20% have had a significant piece of their net worth built by real estate. But my expertise is not in real estate. My expertise is in the stock market and other things when it comes to financial planning. But one of the things I like about the stock market is you get to vote with your feet. You get to vote with your wallet. You know, if you make the investment, let's say you invest in a specific company, and you decide the world is changing. Let's say you invested in the S&P 500, and you think the U.S. has had a great run since World War II, but if you think emerging markets are going to do better than the U.S., or you think other developed countries outside of the U.S. are going to do better in the next decade, you can easily and relatively inexpensively make that transition. But if you're invested in real estate, it can be costly and it can take time to invest and to get a decent price. So those are the main points. Again, I'm not saying one is better than the other. I'm not giving financial advice, but those are some of the pros and cons as a financial advisor that I look at. And if you're interested in this video, you know, most of my audience is either around boomer age, Gen X age, or has somebody in their family that's of that age. And that's why I made this video here. Unfortunately, many boomers are in trouble. They're not prepared to retire. And that's what this video talks about here, why boomers are in trouble. Thanks for watching this video, and I'll see you in that one. Bye-bye.